down now. Rahul Jain is head of APAC Financials and India Equity Research at Goldman Sachs. He's with us now with this call on financials. Rahul, great to have you with us here on the program. Good morning. Prashant here. I think that tweet from Mr. Uday Kotak over the weekend got a lot of traction, got a lot of attention. And we'll have that tweet up in just a bit from now. What did you make of it? And how to read it how did you read it as a banking analyst?
Prashant, good morning and good to be back on your show. Look, I guess, before I specifically get into your question, let me just paint a broader picture for your viewers. At the market level, I think we are seeing the stock market kind of bottoming out, and there are opportunities that are opening up. And even banking sector, which has outperformed in the last couple of weeks in particular. But the fundamentals are still looking a bit like a muddle-through scenario at this point of time. And liquidity is an important area where I think while the RBI has been trying to do a lot more, but the banks are still looking to raise money at an expensive rate. There has been a rush to raise the year-end deposits. So we've seen a significant activity in the certificate of deposits, and some banks even offered higher interest rates there. And I guess the point that you're referring to is on the margin about the incremental profitability that you're making on incremental borrowing. So I think it kind of allows me to also segue into my overall view on the sector. And there we see the muddle-through scenario to continue for the banking sector. We have seen the latest data points coming out of the RBI, which suggests that the credit growth continue to decelerate across different segments, be it the unsecured loans or mortgages or the industrial loans. So there is a deceleration of activity, which does not augur well for the EPS. We have been making a point to our investors that EPS growth could face some challenges, and it'll be at least a quarter or two phenomena before EPS growth starts to get bottomed out. The EPS cuts start to bottom out. So that's the scenario we are in, and that's what you're referring to through this point of the tweet that you just talked about.
All right. Hi, Rahul. Good morning and good to see you, Ben. I think the point that he is making is that NIMs will be under pressure. It's debatable when he talks about the home loans because that's for a longer tenure. But that's the point that he made with regard to the borrowing cost as well as how he sees NIMs to continue to remain under pressure. Rahul, the credit growth has slowed down. I think it's come down to around 11% or thereabouts. What kind of a number you're working with, for FY26, the first half? Do you expect it to be in these early teens itself?
Thank you, Nigel. And that's a very good point. Yes, I think credit growth would remain sluggish for the year fiscal 26 and even could take time to recover even in fiscal 27. So we are working with a range of about 10 to 12%. And this actually would be true across the board. We've already seen, for example, I just talked about unsecured moderated. Mortgages moderated. One of the credit bureau's recent report also suggested that the incremental originations are down. And that is something which won't really be good for the sector credit growth, at least in the near term. I think though the respite could potentially come from the rate cuts and the income tax cuts that the government has rolled out from this year. We'll see how it plays out over the next couple of quarters, but definitely those are the good starting point from the policy makers. And that's what we are asking our investors that, look, the harder the things gets, the policymakers would come out to support. And we have seen that's been happening from both the Government of India as well as the Reserve Bank of India. So that should provide some support. But I think at an overarching level, we should work with about 10 to 12% kind of a growth assumption for the next year and a half.
Oh, that's quite sobering, Rahul. Hi, morning, Surabhi here. So just 10 to 12% credit growth, that suggests that things will not start flying immediately. You are more cautious. So then take us through sort of how to play this, what to buy in the sector, because a lot of people are betting big on financials finally recovering and maybe even leading this market higher. But the numbers that you're talking about don't entirely support that. So how should an investor play the sector?
So look, I guess it's the confluence of multiple factors that shows up in the EPS. So credit is one of the factors. And as Nigel earlier talked about, NIM's also going to be in pressure. Credit costs will take a quarter or two. But look, I guess the sector starts to bottom out. Any sector, whether it's banks or otherwise, starts to bottom out if you start getting the visibility on the EPS cuts getting bottomed out, which in our view is going to be most likely by the September quarter. I think whatever has to be reflected in the earnings, be it the elevated credit cost or a lower margin, should by and large get reflected. Plus, we are seeing the policymakers supporting the sector. That should bring down the risk premium on the sector. That improves the cost of equity. And that's what you've seen in the last month and a half happen. Some of these banking stocks have done well. From here, we clearly believe that the names which can provide visibility on the earnings growth or have better optionality on the asset quality. So we've been favoring the commercial retail theme in general, or segments which are likely to bottom out first. For example, credit cards. On your show, we debated this last time. Those are some of the pockets where where things will start to look better over the next few quarters, and investors will be buying into these names. So for your viewers, I think we would really stick with the names where the EPS growth looks healthy, and the ROAs also looks predictable. I think those are the names that are likely to do well over the next few months or few quarters.
Yeah, I don't know. I guess you can't talk about those specific names, but we have them flashing on the screen, so let's put them up. So the preferred Goldman Sachs picks are HDFC Bank, Kotak Mahindra Bank, AU Small Finance Banks. And in NBFCs, the names are Chola Finance, SBI Card, like Rahul just mentioned, that credit card business is likely to bottom out, Shriram Finance, Aavas, and L&T Finance. On diversified NBFCs, what would be your order of preference? I don't see too many consumer financing giants here, but however, you have a SBI card, so credit cards is there. I don't see housing finance names here. So just what's your order of preference on NBFCs and why?
Yeah, so look, I guess the commercial retail theme looks quite appealing to us because that's a theme that will recover the fastest as the GDP starts to recover. Our house view is that this at best a cyclical slowdown and not a structural one. And with the measure that the RBI, the government is taking, should help revive the GDP growth. We've already seen that crossing the 6% mark. And next year, our assumption is north of 6% in terms of real GDP. And that should actually work out very well for the commercial retail names. So those are the names within the NBFC that we like. To talk specifically about, let's say, housing, I earlier alluded to this point that the originations are lower versus last year. And there is a pricing pressure. I think there are a segment of players who are offering very competitive rates in that segment. So that segment is continue to face some sort of a pressure on the margins. But commercial retail is a theme that should bounce back faster and should print good EPS numbers in our view.
Rahul, just one last quick point. Out of, I think you like HDFC, as Surabhi said. HDFC, by the way, has quietly moved up about 20% from 1,600 levels to where it is now. Kotak, I think, is also something you like. Out of the lot, since you said it's a bit of a muddle through for a couple of quarters, you think Kotak, just because, I mean, the size is still relative to ICICI, HDFC, etc., is small, and they've got new leadership at the top. They're present in pretty much all segments. So the room, I mean, in a way, it's like where ICICI was 4 or 5 years back. The balance sheet can grow faster. I mean, the room to grow is in that sense higher. Would you be willing to bet on something like that? What's your sense?
Without getting into the specifics, Prashant, I think the setup for any stock to do well is about the predictability of the earnings. And clearly, some of the names where you have the runway of growth being better over the next few years, with some of the pockets which are starting to do well or would do well as the government looks out to support the broader economy, should technically do well. So I would just leave it at that. But clearly, I think it boils down to the earnings growth, or how long of a cycle that you can grow at. And some of these names have in particular done well over the last few quarters. So the market should reward, as the earnings growth start to come in.
Okay. All right. Rahul, we'll leave it there for now. Thank you very much for joining us. Appreciate it here on CNBC TV18. I think Vodafone